You should be looking to buy right now. It is a golden opportunity because you can buy that home, and as interest rate market gets more favorable and rates decline, it's going to boost prices higher, and then you have opportunities to refinance to the lower rate, which is the best of all worlds. Hey guys, today we are covering the 2024 forecast. So we're going to be going through inflation projections, Fed balance sheet and rate cut odds, and the housing breakdown. Now, we'll credit Barry Habib, who's a 3-time award winner of the Zillow.com's Crystal Ball Award for accurate real estate forecasts. So that's out of 150 of the nation's top economists. So I think this is going to be some really valuable information for you here. Now, our 2024 forecast centers a lot around supply and demand, and most prices are determined by supply and demand, but more than ever, real estate as well as the direction of interest rates will be focused on supply and demand. So let's begin with inflation because it's a big driver of interest rates. And as we take a look at inflation, where it stands at the beginning of the year is the core CPI number is 4%. Now, the core PCE number, these are both in the numbers that the Fed looks at. Most importantly, PCE is at 3.2%. So CPI is the consumer price index. PCE is the personal consumption expenditure. Now, the Fed wants this personal consumption expenditure to get to 2%, and that is the target. But in December, the Fed meeting caused a major pivot. The Fed finally came out and said, hey, we're not going to wait to start cutting rates for PCE core to get to 2%. We'll just start cutting rates before it gets to 2%. Now, when asked about it, Jerome Powell didn't give an exact rate where he would start, but we could start handicapping it now at this point. And so let's take a look at the direction of where we think inflation will go. So much inflation numbers are based on shelter costs and shelters or rents and owners equivalent rents. So what do they look like today? Well, if you take a look at the blended rent, they're going up at 2% year over year. And you can see here that they went up really high and now they've come down from their accelerated levels, but they're still going up, but it's only at 2.5% per year. Now, new rents are going up at about -1% a year, so they're actually coming down, but rental renewals are going up at 4.5% a year. So you blend those two together, and the overall rate is about 2.5% per year where rents are rising, but that is a lot less than what it was. The problem here is that the Fed doesn't look at what we are currently looking at. The Fed takes the last 12 months and averages them. On top of that, people could have signed a lease in advance of that, so that makes the Fed's data a bit wonky. So you can have a very long lag, and that's evidenced here because the way the Fed looks at it is this gold line. And you can see here was the peak, but much later on, we get the peak here and start coming down here and then start coming down here. So you can see that these numbers lag, but eventually they're starting to get to a similar location. And that's basically where we are today. We are seeing the Feds looking at these numbers, but really we're much lower. The weighting within the inflation report and CPI report is rather significant. The shelter is 44% of it, and on the PCE report, it's 21% of it. So there's an enormous overstatement here. The difference between these two is really significant. And when you take the mathematical difference, let's say CPI 4% difference, apply it by the weighting, you'll see there's a huge lag effect here. And when we take into account the lag between both CPI and PCE and apply it to what it would really be today, well, you'd be looking at a much closer rate to the Fed's target of 2.2. And in fact, if you take a look at what the last 6 months of this has been, and we do know that the Fed does look at that, it's actually below 2%. It's 1.85%. So these are important numbers. The trend in inflation is working in our favor, and that means the Fed's going to have to look at cutting rates soon. So what can we look forward to in the upcoming CPI or PCE reports, knowing that shelter is such an enormous factor? Now, the way it works is you'll get a new number, and the next report that we'll get for shelter and CPI will be released January 11th. That's for the month of December of 2023, and that's going to replace the number that was for December 2022. And as you can see, here's what the number was, and it was a pretty high number. By the way, the PCE number will be released January 26th. So this higher number will likely be replaced by a lower number. We've been trending here since June of last year. It's been about 0.4%. So if we get a number of roughly 0.8% replaced by 0.4%, you can see that we get a pretty strong benefit there. And that will be again happening in the month of January and February, which we'll see in February and March. So the first quarter of 2024, the releases that we should get on the inflation should be quite favorable. We should see inflation come down. Now, after that wonderful first quarter, it is going to get a little bit harder to make progress. We could see some progress, but it's going to be a little bit trickier. We should make quite a bit of headway this first quarter, and that means better inflation numbers, and the market should really like that. Now, what would that mean as far as what the Fed looks at? Well, let's take a look at the current core PCE again. This is the one the Fed most closely watches. So how does the math work on that? Well, on January 26th, we'll get the December reading for core PCE for December of 2023, and we're going to estimate that it's going to come in at 0.1%. And a big reason for that is because I showed you we should make a lot of headway on the shelter costs, and the same should go for January and February. So we know this based upon what I just showed you, and the shelter, we should see relatively low numbers, but take a look at the rest of the year. So what we've done is we've plugged in 0.2%. It's a reasonable estimate of what we might get. So the way it works is as we get the new number, it replaces the year on overall core PCE from the previous year, which is 0.39. And in this example, as you can see, 0.1 is lower than 0.39. It's lower by 0.29. So if you subtract 0.29 from the current reading, what would you get? You get 2.87. So 3.16 minus the difference between these two is 0.29, which means that core inflation should be 2.87. It's below 3. It's below 3. It's in the 2s, but it's not quite close enough to the Fed's target, I think, for them to take a position and start cutting. And the next Fed meeting will occur. It'll be just 5 days after that on January 31st. While I do think they'll like the number, I don't think they'll be ready to cut just yet. So let's take a look at what they'll see by their March 20th meeting. They'll see a reading of 2.47. We think that this just might do the trick, reading just under 2.5% for the Fed to start cutting before they get to 2%. We think that there's a good possibility that on March 20th, we'll get the first Fed rate cut, but certainly by May 1st. As you can see, we get under the target here, so they may actually overshoot. So what does the market say on this? Well, there's actually odds makers, just like there would be on DraftKings or something for betting on a football game. There's odds on what the Fed is going to do. You can pretty much bet on anything these days. So just like what we think, they feel that there's a 7% chance by January 31st that they'll start cutting. So remember that the core PCE would be 2.87. So we don't think that's going to be enough for the Fed to start cutting rates. But certainly by March, we think, and the majority of odds makers, they think that the Fed should cut March 20th. And then, as you can see here, the chances are pretty much assured that by May 1st, we'll get the first rate cut. There are pretty good odds that we'll have multiple rate cuts by May and into June, 56% chance of at least 50 basis points cumulatively. And by June, there's a 53% chance that you'll have 3 25 basis point cuts by June 12th. Now, let's get into the minds of the Fed. So what the Fed does is anonymously, they plot these dots. Each dot is this 2023, this is 2024, 2025, 2026. This is where each of the 19 Fed members thinks that we'll have the Fed funds rate. Right now, the federal funds rate is between 5.25% and 5.5%. So 2 Fed members think that there should not be any cuts in 2024. One thinks we should have at least 25 basis point cut. 5 of them look at 50 basis points. 6 say 75 basis points. 4 say 100. 1 says 150 basis points in cuts. So that's rather significant. So the bias here is towards at least 3, maybe 4 rate cuts in 2024. Let's take a look ahead to 2025. Notice something? And do you notice something again in 2026? You see the trajectory here. Look, if you survived the tough year of 2023, well, congratulations, because now you should get a tailwind here. So you should see lower rates in 2024 and lower rates again in 2025 and lower rates again in 2026. So think of what that does for people's ability to do refinances and think of what that does for purchases. You should be looking to buy right now. It is a golden opportunity because you can buy that home, and as interest rate market gets more favorable and rates decline, it's going to boost prices higher, and then you'd have opportunities to refinance to the lower rate, which is the best of all worlds. Now, something that's very important to watch is the Fed's balance sheet. Because we talked about supply and demand, and what has been hurting rates through most of 2023 is the Fed's reducing of its balance sheet. They had their balance sheet go up during the great financial crisis, certainly, and it goes up much higher during COVID crisis with $8.5 trillion. So that was just too high. The Fed said, hey, we got to start offloading this, and they've done that successfully. So these are the outright holdings of treasuries and mortgage-backed securities, and they've offloaded $1.4 trillion. So that's been a big move lower in this. So the Fed feels better about that, but it came at a cost because as they were doing this, U.S. interest rates started to rise because now we had to absorb all of this right here. But recently, interest rates have gotten better, and that is because expectation of lower rates is causing banks to aggressively start buying treasuries and locking in the higher rates in anticipation that rates are going to go lower. So let's take a peek here at what the Fed might be comfortable with on their balance sheet, because that will be critical is when the Fed is going to slow down or eventually stop that runoff and stop that added supply of treasuries and mortgage-backed securities in the market. Let's take a look at some history here. Between 2014 and 2018, in a 5-year period, the average that the Fed held on their balance sheet was much lower, about half of what it is at the peak of $4.25 trillion. Now, our GDP was $19 trillion, so that was about 22% or so, between 22 and 23% of GDP. Now, before COVID, notice the balance sheet went up. But because GDP went up, the percentage came down, so they were good with that. But at the peak of about $8.5 trillion, even though our GDP went up significantly, it was just too high of a percentage on the balance sheet. It was at 33%, and they had to offload it. So here's where we are now. Again, they've offloaded this, come from roughly $8.5 trillion to $7.1 trillion. Our GDP has gone up. So the percentage has come down from 33 to 25, but probably above the Fed's comfort zone. So how will this all pan out? Well, we know what this is because we already know what the runoff is going to be. So we can take a reasonable guess at what GDP will do, and here's what the numbers would look like. So as we go through each month, you can see that as we get into March area, right before March 20th meeting for the Fed, it's below 25%. We kind of think that's too high of a number for the Fed to be comfortable, and they'd like to be lower. Now, the Fed may cut rates by March 20th, but I think they'll continue to run off on the balance sheet, so we won't see the full benefit here. So as we get into the May meeting, it'll get under 25%, at 24.5%. In June, it gets near 24%. But now, when you start to see what happens in the second half of the year, you get to a level where the Fed is going to be much more comfortable. And we think that this is a good time in the second half of the year, especially out of an election, to get some pressure saying, hey, we've got to slow down what's going on with the balance sheet here. And as they slow down the balance sheet, as they put themselves in a position to do so, if they overshoot, we'll get a recession. And you can see here mortgage rates during these shaded areas, recessions, mortgage rates decline. But the Fed's balance sheet will be a critical component because less supply on the housing market means that interest rates should improve because the buyers are going to be bidding on less amount of paper and the supply that's available. So what's the rate forecast for 2024? For 2024, we see 30-year fixed rate mortgages in the mid fives to high fives in the 6% range. So under 6% rate on mortgages should unlock move-up buyers and create more activity. So on the 10-year Treasury, we see it between 3 and 4.4. We start the year a little bit above 4. We think the overall trend, while it might move up and down a little bit, it's certainly not going to move in a straight line. The overall trend will gravitate towards 3%. And maybe we get a more normal return to the spread between the treasuries and the mortgage rate, which is around 2%, not 3%. That should help mortgage rates reduce as well. So let's turn our attention to real estate here. Our forecast here for real estate centers again on supply and demand. And the supply is tight. Look at inventory over the past 10 years, how it continues to decline while our population is going up. And you think about record demand is continuing to be very strong. These blue lines here represent households being formed. And what you can see is that households are being formed much faster than builders are putting up homes. So this is why the real estate market has been so strong lately and why you're seeing prices increase is because of the lack of inventory. So it's going to be a similar story in 2024. We don't see much more inventory, although we do see more activity, but we don't get the amount of supply coming to the market meeting the demand. So that's why prices should stay firm. There is an argument about affordability, and let's talk about it because people say, well, prices have to come down and it's not affordable. It is less affordable. Nobody can argue with that. When you compare it to 2021 prices, rates have gone up, home prices have gone up, but we don't really talk a lot about the income portion of it, and that is the real key. So let's take a look at an example. In 2021, if you had a $1,000 mortgage payment because you were taking out a $240,000 mortgage at 2.875%, your principal and interest payment would be roughly $1,000. Your income to qualify for that principal and interest payment would have to be roughly $4,000 a month. Now we see that rates have gone up, but not only have the rates gone up, the real estate prices have gone up. So you have to take out a bigger mortgage at a higher rate, and that is what people look at. So 6.625%, if you had a higher mortgage, your monthly payment went up by $800 a month. So people say $800 a month, that's an 80% increase, and that's not affordable. The problem is with that type of thinking is that although this is significant, you don't need an 80% increase in your income to offset an $800 monthly payment. What do you need? Well, you need a 20% increase in your income to offset an $800 monthly increase in your payment. And incomes have already risen by 15% since 2021. Look, this is a simple way to look at it, but while there are many nuances, the majority of this is something that tells us that by the end of 2024, as incomes go up, perhaps another 5% or so, we should be in a position with rates coming down to totally alleviate this affordability issue. So what's our forecast? 4.5%, 5% nationwide. What I think is even more important is we're going to have a very solid market for real estate values, and we're going to see a big increase in overall transactions. So that means more people selling their homes, means more opportunities for people to buy homes. So it's going to be a great year in 2024. Thank you all for watching, and I wish you well.